Good day everyone, my name is Danica V. Hakalan and my topic is all about assessing credit risk under credit policies. So first I will discuss to you the credit policies. So a credit policy contains guidelines that structure the amount of credit granted to customers as well as how collections are to be deducted for delinquent accounts. In an organization, it is necessary to have a policy because policy is um, policy is used as guides for the members of an organization as they perform their jobs. So each organization have different policies. Depende na sa ila kung giunsa nila og unsa ilahang mga policies nga implement sa ilahang organization. So policies is made for guidelines. Without guidelines, they may not be able to perform their job efficiently and effectively. So policies reflect the objectives and management philosophy of the organization. So this means that the objectives of an organization should in line with their management philosophy. So in the definition, a credit policy contains guidelines that structure the amount of credit granted to customers. So before isa ka organization na grant loan, for example, loan sa isa ka customer, naa sila gina-follow nga guidelines before sila mohatag before sila mo grant og loan sa isa ka customer. Assessing credit risk. Assessment of credit risk requires modeling the probability of a counterparty defaulting obligations wholly in one part. The credit decision may be granting of credit or refuse of credit. For a business, the essence of credit risk management is to balance the gain from the credit risk by extending a credit against the potential loss. The credit risk decision facing a firm relates to the gain if there is no default. The potential loss from extending credit based on the likelihood that default takes place and the amount lost if a default occurs. So, one example of this is when you are planning to apply a loan in an organization or a bank, they will likely approve or decline your application in the loan. So it depends kung yung imuhang background sa history kung mag-loan ka is positive or negative. So in the definition, for a business, the essence of credit risk management is to balance the gain from the credit risk by extending a credit against the potential loss. So kung dili ka ma-approve sa imong loan, the bank is kanang galikay lang sila sa ilahang possible nga loss if ila kang ipautang. So there is really a need on assessing credit risk in every organization, especially on the organization that offers credit. There are two possible outcomes of credit risk. Number one, credit performs based on the expectations, and number two, credit default. So number one, credit performs based on the expectations. So this means that the borrower is evaluated before being approved. So it seems that the organization will conduct a analyzing on your credit background, and then later it will maybe it will be approved or declined by the bank or the organization. Number 2 is credit default. So the definition of default is, in a financial term, used when a credit agreement has been broken. If you're unable to make payments or you don't pay the right amount, your creditor may send you default notice. If the default is applied, it could affect your credit file. So, ang akong pagsabot ani is, kung ang inyong credit agreement sa imuhang lender or sa organization nga imuhang gi-applyan og loan, and then ikaw dili ka makabayad in time, so this will reflect in your credit file. So puhon kung mangutang na pud ka, and then makita sa imuhang utangan nga ang imong credit file is pangit, so it has a big possibility nga ma-decline ka or i-grant kanila og loan with the higher interest. So there are 4 determinants of credit risk assessment. So the 4 key factors influencing a credit risk assessment is number 1, concentration risk, number 2, settlement risk, number 3, industry risk, and number 4, country risk. So as mentioned earlier ganina sa akong kuan, individual credit risk should be assessed. So mao ni siya. Number 1, concentration risk arises when there are many exposure to parties that share similar characteristics. Number 2, settlement risk arises when a clearing agent or third party processes transaction for other parties. Number 3, industry risk applies mainly when the domestic or international economy is in recession and the poor economic condition affects specified industries. And lastly, country risk arises from exposure to individuals and institutions in countries with legal systems, business codes, and standards that differ from those of the leader. So that will be our my topic, and that would be all. Thank you for listening and watching my video.